When people hear the word quant, they usually picture one type of person: a mathematical genius in front of 10 monitors, writing complicated equations and making millions in seconds. But a quant is not one job. A quant researcher, a quant developer, and a quant trader can all work on the same trading strategy, and they handle completely different parts of it. The easiest way to understand the roles is to follow one trading idea from beginning to end. Idea, data, model, backtest, production, trade, risk. By the end of this video, you will know who owns each part of that journey and which role might fit you. The word quant is short for quantitative. It simply means using numbers, data, and mathematics to make decisions. A normal investor says, "I think this stock is about to rise." A quant asks a different set of questions: what the data shows, whether this pattern happened before, how often it worked, and whether it still makes money after all the costs. Quants work at hedge funds, banks, and specialized trading firms. Now let us follow one idea through a firm like that. Imagine someone notices something interesting. When a stock suddenly gets far more buying activity than usual, its price often keeps rising for the next few minutes. That suggests a possible trade: buy when buying activity jumps and sell a few minutes later. Right now, this is only a guess. Markets are full of patterns that look real but are pure coincidence. Before risking real money, the firm needs evidence, and evidence starts with data. This is where the data engineer comes in. Markets create enormous amounts of information every second. Prices change, orders appear and cancel, trades complete, news breaks. And the raw feed is messy. Records go missing, timestamps are wrong. The same company has different names in different systems. The data engineer collects all of it, cleans it, and organizes it so everyone else can trust it. Think of a chef's ingredients. The best chef in the world cannot cook a good meal from spoiled ingredients. Models are the same. There is a phrase for this: garbage in, garbage out. For our idea, the data engineer prepares years of clean history on prices, orders, and trades. Now, the idea can finally be tested. Next, the quant researcher takes over. A researcher works like a scientist. They turn the vague idea into exact rules. What counts is unusually high buying activity, 20% above normal, or double, how long to hold the stock, and when to sell. The result is called a model. A model is simply a set of rules that turns data into a decision. The model's output is called a signal. A signal tells the system one of three things: buy, sell, or do nothing. But building a model proves nothing yet. Now it has to face the past. The researcher runs the model against old market data. This is called backtesting. Backtesting means pretending the strategy existed in the past and measuring what would have happened. It is like inventing a new football tactic, then rewatching last season's matches to see whether it would have helped. Suppose 10 years of data show the strategy would have made £2 million. That sounds excellent. This is exactly where researchers must be most careful. The biggest trap is called overfitting. Overfitting means the model memorized the past instead of learning a real pattern. It is like preparing for an exam by memorizing last year's answers. If the same questions appear, you score perfectly. If the questions change, you are lost. An overfitted model works beautifully on old data and falls apart on new data. Real costs matter too. Every trade has fees. Prices move between deciding and executing, and a very large order can push the price all by itself. That effect is called market impact. Buying every ticket to a popular concert has the same problem. Sellers notice the demand, and prices rise. A good researcher checks that the strategy survives the fees, works in different market conditions, and works on data it has never seen. Suppose ours survives all of it. There is still a gap between working on a laptop and safely running real money. This is where the quant developer becomes essential. The researcher's code was an experiment, good enough for testing an idea, not good enough to run all day, every day, with real money on the line. The live system must take in market data continuously, make decisions quickly, send the correct orders, record everything it does, and recover when something breaks. It cannot crash in the middle of a trade. The developer turns the experiment into production software. Production simply means the real system, not a test. Think of a car engine. The researcher proves the engine design can work. The developer makes sure it starts every morning and survives the motorway. Developers also build the firm's shared tools, and they make experiments repeatable, so two people running the same test get the same answer. The simplest way to separate the two roles is this. The researcher asks whether the idea could work. The developer makes it work reliably in the real world. In some kinds of trading, being right is not enough. The system must also be fast. This is the world of the low latency engineer. Latency means delay. Low latency means keeping that delay as small as possible. A millisecond is 1,000th of a second, and in some strategies, a single millisecond decides who wins. Imagine two firms spotting the same opportunity. Both send an order to the exchange. An exchange is simply the marketplace where buyers and sellers trade. The first order gets the deal. The second arrives too late. Low latency engineers build the systems that receive market data and send orders as fast as possible. They do not choose what to buy. They make sure the strategy can act before the opportunity disappears. Once real money is trading, the quant trader takes the watch. The trader monitors the strategy live, how much it is making or losing, whether it is behaving as expected. And when something looks wrong, the trader can reduce it, pause it, or shut it down completely. Traders also help decide position size. Position size means how much money to place behind each trade. Even a good model is wrong a lot of the time. Being 70% confident that a team will win does not mean betting your entire savings on the match. The size of the bet matters as much as the prediction. One question remains. Every strategy is sometimes wrong. This is where the risk quant comes in. The researcher asks how the strategy makes money. The risk quant asks how it loses money. What happens if the whole market falls? What happens if several strategies lose at the same time? And what the worst realistic loss looks like. Risk quants run stress tests. A stress test places the strategy inside an imaginary crisis and measures the damage. It is like testing whether a building survives an earthquake. The goal is not predicting the date of the next earthquake. The goal is knowing the building is ready. Risk quants also set hard limits, a maximum amount of money the strategy can use, a loss level where it must stop trading, and no overdependence on one company, one industry, or one market. Above all of this sits the portfolio manager. A portfolio is simply a collection of strategies. The portfolio manager decides how the strategies fit together and how much money each one receives. Now the full journey, end to end. An idea appears. The data engineer prepares trustworthy data. The quant researcher turns the idea into a model and backtests it against history. The quant developer turns it into reliable production software. The low latency engineer makes it fast. The quant trader supervises it in the live market. The risk quant measures what could go wrong. And the portfolio manager decides how much money it receives. Everyone works on the same strategy. Each person owns a different part of its journey. Not every quant fits this pipeline. Two more roles are common at large investment banks. A pricing quant calculates what a complicated financial product should be worth. An option, for example, is a contract giving someone the right to buy or sell an asset under specific conditions. Nobody knows what markets will do, so putting a fair price on that contract takes serious mathematics. Pricing quants also help the bank with hedging. Hedging means taking a second position that protects you if the market moves against you. It works like carrying an umbrella. The umbrella does not stop the rain, it reduces the damage. A model validation quant independently reviews the models that other teams built. They question the assumptions, they retest the results, and they search for the conditions where the model fails. One team designs the aeroplane, a separate team decides whether it is safe to fly. The independence is the whole point. So the question of which role fits you. If you enjoy statistics, experiments, and discovering patterns, look at quant research. If you enjoy building reliable software, look at quant development. If you enjoy markets and quick decisions, look at quant trading. If you enjoy making computers incredibly fast, look at low latency engineering. If you naturally imagine what could go wrong, look at risk or model validation. And if you enjoy hard financial mathematics, look at pricing. One warning, job titles in this field are messy. The same role can be called quant developer at one firm and research engineer at another. Judge the role by what the person actually does, never by the title. A quant is not one job. It is a team of people using data, mathematics, and software to solve different parts of the same problem. So the next time someone tells you they work as a quant, you know the right question to ask. The question is, what kind of quant?